Personal finances can be stressful as all hell, but they by no means have to be complicated. The simpler your approach, the more likely you are to be consistent and reach your goals. So with that said, when it comes to investing in stocks, the simplest strategy you can follow is dollar cost averaging index funds. For today's video, let's talk about why. Really quick, for those unfamiliar with dollar cost averaging index funds, two definitions to go over. Dollar cost averaging is an approach to purchasing an investment in which the buyer spreads out their purchases so that the total price paid is less affected by market timing. More on that last part in a minute. An index fund is a type of mutual fund or exchange-traded fund with a portfolio constructed to match or track the components of a financial market index. So to dollar cost average index funds means to invest in a portfolio tracking a stock index like the S&P 500 over a period of time. Typically, an investor would implement this by creating an investment schedule in which they invest X amount of dollars every month, week, or even day into their fund of choice. And it really is that simple. The first reason you'd want to follow this strategy is because it removes the element of market timing. Market timing is a cardinal sin in retail investing. There is no reason you should be trying to time the highs and lows of the market. Why? Because it's impossible to do consistently. Much like a roulette table, you may get lucky once or twice, but that doesn't change the odds in your favor. All too often, investors fall into the trap of timing the market because they're constantly told to buy low, sell high. And although that's exactly what you have to do, in the short term, no one truly knows what's low and what's high. What ends up happening is investors wait for the bottom of a stock market decline before investing, and while they wait, they miss crucial moments of stock market gains. Looking at some data from Bank of America, note that over the last 90 years, if you could accurately predict stock price movements and uninvested during the 10 worst days in each decade, your return would be nearly 3 million %. But if you missed the 10 best days in each decade, which would likely happen while you waited for lower prices, your return would be a worthless 28%. It's pretty astounding the difference between perfect timing and terrible timing, but why subject yourself to not only the stress, but the extreme unlikelihood of being a perfect investor? Can you honestly tell me that you could exactly identify the best 90 days of stock gains and the worst 90 days of stock losses over a 90-year period? It's just not a realistic approach to investing, and sure, professional investors have some success timing the market, but their methods are anything but simple. And complex strategies will deter you from investing more times than not. The next reason to follow this strategy is it protects you from volatile price fluctuations. The thing you have to remember about the stock market is that the day-to-day stock prices don't necessarily reflect real changes in the underlying company's worth. And that's because in the short term, there are a lot more factors that impact a stock's price than solely the company's intrinsic value. Let's look at the relationship between the market stock price and a company's intrinsic value. What we see is that the market price varies significantly relative to intrinsic value, and this variance is what we call volatility. Note that when the market price is above intrinsic value, the stock is overvalued, and when it's below, the stock is undervalued. The beauty of dollar cost averaging is that you don't have to guess where market prices are relative to intrinsic value. That's because you're investing in increments over time. At some points, you're investing when the stock is expensive, and at other points, you're investing when it's cheap. The result is that on average, you're investing at intrinsic value without ever having to calculate it, which can be incredibly complicated. So whether you're overpaying or underpaying, in the long run, you'll be investing at a fair price. Another great reason to follow this strategy is that index funds provide easy diversification. They give you exposure to numerous companies of different sizes of various industries without having to handpick each stock. You see, the two main issues with investing in individual stocks are one, it's risky, and two, it takes a lot of work. The risk part is best explained by the proverbial never put all your eggs in one basket. When you own a few individual stocks, you're assuming nearly 100% of the risk those companies face. And as for the hard work part, you'll be spending a lot of your time researching a company's business model, their financials, and their competition. So save yourself the risk and the time of picking individual stocks and take advantage of the instant diversification. There is one thing to note about index funds. There's a ton of them. Think of any industry or some company characteristic like size, and I'll bet there's an index tracking it. Whether you're looking for exposure to tech stocks or smaller companies or for an industry, what starts off as a simple approach to investing can quickly become complicated. So my suggestion is to avoid owning every index fund in existence and instead hold only a handful that are representative of the major stock indices. And if you really want to simplify your investing, there's honestly only one index you need, the S&P 500. By owning an S&P 500 index fund, you'll partially own over 500 of the US's largest publicly traded corporations that represent an entire spectrum of industries. There's a mixture of growth companies, dividend payers, and your legacy businesses like Coca-Cola. The historical performance of the S&P is second to none, with annualized returns of about 10% over the last 60 plus years. And the only reason you need to invest in the S&P 500 is a belief in American industry and innovation. The last reason I'll give you to start dollar cost averaging index funds is that this strategy is one of the cheapest out there. The benefit of a simple investing strategy is that you can implement it yourself. There's no need to pay for the services of a financial professional. And although a financial professional may be right for your situation, you have to consider the cost. A typical financial advisor's management fee is 1%, in which they'll annually charge 1% of the total assets they manage for you. 1% may not seem like a lot, but it absolutely adds up. But you don't just save money on a financial advisor with this strategy, you also save money on the type of asset you're investing in. Index funds are incredibly cost-effective compared to other funds that are actively managed. Actively managed funds entail high expense ratios to pay for the management team, actively trading stock positions in pursuit of returns that outperform the market. Mutual funds have expense ratios that can range from around 0.5% to multiple percentage points. Compare that to many index funds with expense ratios of damn near zero, and there's just no contest. Even if you want to pay for the chance to outperform the market, keep this in mind. Over the last 15 years, only 10% of fund managers were able to beat the S&P 500, and even less were successful if you push that out to 20 years. So to wrap this video up, as I often do, let me show you the power of a simple investing strategy that you can consistently follow over long periods of time. Let's say your index fund of choice is an S&P 500 ETF with a negligible expense ratio. And let's say you'll be dollar cost averaging $500 a month over the next 40 years. Also assuming the S&P continues its exceptional performance of earning 10% a year, and your final investment would be worth nearly $2.7 million. Now consider implementing this using a tax-advantaged retirement account, and my friends, you'll be golden. Simple, but extremely effective. And that's all I have for today's quick video. If you enjoyed the video, I invite you to like, comment, and subscribe if you haven't already. As always, thank you for watching. Until next time, take care of yourself and best of luck.